Is going on in your two to watch here this morning?
Well, Bank of Nova Scotia's fourth quarter profit topped analyst expectations, and our next guest says Scotia's international strategy makes it an interesting stock to own. For some shareholder reaction to the bank's latest earnings and a lot more besides, we're joined by David Burrows, President of Barometer Capital Markets. David, great to have you back. Before we get into Bank of Nova Scotia, curious your thinking on the jobs data out of the U.S. It was so contentious, and Canada, contentious in the U.S. in the election. Numbers are getting incrementally stronger and stronger, and the Canadian numbers still so very spiky. What does it do for your outlook for the two economies?
Well, I think clearly, this is good for the consumer side of things. These have been noisy numbers on both sides of the border. I think there's a few takeaways. First of all, in the Canadian number, that strong number probably reflects stronger auto, because we've been seeing stronger auto numbers in the U.S., and of course we get impacted so significantly by auto manufacture here in Ontario. So that's a positive. In the U.S., there's positives and negatives in the numbers. The number is a stronger headline number, and there was more job growth. At the same time, the bigger impact on the unemployment rate were the number of folks that fell out of the employment workforce. So that's a bit of a noisy number. But in general, we see a continuation of a little bit stronger on the consumer side. And the negative out there is the manufacturing data and the industrial production data, which shows that the capital spending and so on has been a little bit weak.
And we'll see the effect for the U.S. numbers on the University of Michigan number. We see that at 5 to 10, so we'll get some sense of the confidence in the U.S.
Right.
Let's switch to Bank of Nova Scotia. They reported the results, and as I mentioned, 5 for 5. We've seen better numbers slightly than expectations. Your read on the numbers, and it's this international side that you like.
Yeah, I mean, ultimately it was a clean number, sort of in line with expectation. Overall, I thought there were no real dark spots on the numbers. The very strong expense controls, a little bit better tax rate probably helped things a little bit. But I think what I'm most interested in is the international banking strategy seems to continue to work nicely. Good, strong growth, 22% growth, a little bit better than expectation. Global wealth management, I think, was strong. I think their Canadian retail banking was in line, which, some of the banks have missed a little bit on the Canadian retail banking. I think that's sort of the drag on the numbers in general. So I thought it was a good, clean number.
Do you want to see this bank making more acquisitions in that same vein? Do you want to see them going further afield?
Look, if you just look at the basic fundamentals, if you look at Mexico, for instance, Mexico has an underlevered economy. They've got the lowest leverage in all of the developed countries. They've got a population that has the most significant population under the age of 60. So they got young population, they have low debt. This is a good environment for banks to be operating in. So they have an opportunity to grow there, where in Canada we've got a bunch of well-capitalized banks who are chasing after sort of deteriorating or sort of decelerating credit markets, which in a low interest rate environment can point to lower margins. So I think the non-Canadian banking numbers and banking business is attractive, and they're doing a great job in executing.
So the company indicated, Bank of Nova Scotia did, that they see 5 to 10% growth in 2013. Is that enough to buy this bank here? Well,
it's a great question. I should say that overall we are underweight Canadian banks because we do think that there are headwinds in the domestic business. Dividend growth is likely to be a little slower than what people are used to. Return on equity figures are coming down a little bit. And with stronger capitalization, there's just a little less leverage in the business model. So, at 10 or 11 times earnings, is that the right number? Maybe we see the multiple contraction a little bit more. I don't think that there's enough to see an expansion in the earnings multiple for investors.
You still seem a little cautious with regards to the equity outlook for next year. What do you need to see to change it? Is it a fundamental economic change in Europe? Look, is it a solution to the cliff? What do you need to see?
We all know there's lots of big macro issues that are out there, and we spend our time at Barometer trying to understand what the market's telling us. And we have continued to see sloppy behavior in things like commodities, in things like semiconductors, in things like transports, which tend to give you a tell as to where people think things are going. We've seen a series of failed rallies in those areas. On the other hand, we see persistent strength in really dividend growth type stories, not high dividend payers specifically, but dividend growth. And you're seeing lots of companies focus on the dividend policy, whether it's special dividends or otherwise. That has been a persistent theme. We like to stay with things that are working. And if we can get some of those other areas going, then maybe we can look to a little stronger equity markets overall.
One of the areas I understand you like is the midstream energy infrastructure stocks. When I think of those, I think of limited partnerships. Is that what you're talking about or something different?
Well, what I'm thinking of is pipelines, processors, storage facilities, the folks that provide the plumbing to get energy from the ground to market. And while we have this tremendous energy boom going on in North America, and while the pricing for the commodities may be in question, the big bottleneck is the ability to get the stuff to market. So lots of people will say that the pipelines are expensive relative to history, but they didn't have the kind of growth in volumes that they're facing today. So we all paid high multiples for telecom equipment stocks in the late 90s because they were able to de-bottleneck the pipe and get the data through the internet. We're in a situation where we need to de-bottleneck the infrastructure to get energy to market. So I think that over time we get 8 to 12% dividend growth in the group, which is much higher than history, and you probably get multiple expansion along the way.
So does an Enbridge last night raise their dividend? They talk about these big projects that they have on. I've seen some numbers being lifted on an Enbridge. A lot of people say, though, looking at the kind of multiple, and that goes right to the heart of your discussion here. I mean, the multiple on Enbridge right now, 23 times.
Right.
I mean, that's like a growth stock.
So really, if you look at it, in the 1950s and 60s, when dividends became important, dividend payers went to the premium multiple in the market. Now, Enbridge is obviously in the seniors category, and it is trading at a higher multiple, but they do have a higher growth rate. If you look into the mid-sized companies like an AltaGas or an Interpipe, you know, they got lots of opportunity to build new projects and add capacity. And what multiple do you pay for very transparent, long-term growth that we can see in this industry? Yes, relative to history, where there's low volume growth, they are expensive. I think that people are revaluing this group, and you're seeing strategic deals come in at significant premiums. So strategic buyers are prepared to pay the premiums in this market too.
David, do you want to see the CNOOC takeover of Nexen go through? The deadline for the Canadian review is on Monday. Do you want to see the deal done?
Well, look, if you're an investor in midstream energy assets, as we are, you would like to see the strongest credits on both ends of the pipe, right? So if you can have seniors and sovereigns owning both the purchasers of the product and the suppliers, then the cost of capital to borrow to build these assets goes down, and the returns to the shareholders go up. So yeah, you know, I think that we're going to continue to see consolidation both in the mid-sized producers who are supplying into the infrastructure and the end purchasers on the other end.
Do you think the deal will get approved?
We're going to have to see. We're not a stakeholder in Nexen.
All right, David, great to have you back. Thanks for joining us.
Thanks for having me.
We're joined by David Burrows, President, Barometer Capital Management.
And we have a few analysts making some moves this morning. We're going to share those with you when we come back. You're watching the First 15 on BNN.